As we get closer to that increase in the capital gains inclusion rate, there's been lots of debate. One professor is examining the impact that this move might have or not have on Canada's productivity. Let's bring in Kevin Milligan, a professor at UBC. Also, he has been an advisor to the federal cabinet in the past. Professor, thanks very much indeed for joining us.
Thanks for having me on, Andrew.
We've heard commentary to the effect that this has nothing to do with actual economics, that it's a political move, it's a bleed the rich type thing. But your thesis is partly that it's simply equating the taxation on capital gains to the taxation on dividends, just trying to level the playing field when it comes to money people can take out of a company.
Yeah, there's lots of different motivations you can imagine for this capital gains tax change. And it might be because you want to soak the rich. It might be because the government has some political needs. But I'm coming at it as someone who looks at how we design the tax system. And to me, it makes a lot of structural sense for the reason that you say, that we have different ways of getting profit from the company into the shareholders' hands. One is that you do share buybacks that juice up capital gains. Another one is that you pay dividends. And from my point of view, you don't want to have the tax system telling a company which way they ought to pay out their distributions. It should be based on business decisions. And so the tax system should treat both of those methods the same. So that's kind of the structural reason why I think that the dividend tax change makes sense.
Although capital gains, are they the same thing as getting dividends or share buybacks? I mean, in the sense that capital gains are when you're selling out of a company.
Yeah, so what a company can do if they have some spare cash in retained earnings is to buy back on the open market some shares of the company. And then the earnings per share looks better because there's fewer shares out in the open market. And that just means that the price of that stock is going to go up. And that's a way you can transmit the value from the profit of the company into the pocket of the shareholder, right, simply through this kind of capital gains transaction.
What about, I know we can't get into it entirely, but what about entrepreneurs, smaller entrepreneurs like doctors or people running a store? We've heard, well, this is going to compromise their retirement plans. And there's even been suggestions that doctors will leave Canada. How would you answer that kind of concern?
Yeah, whenever you make a change to this kind of taxation, you always want to worry about what's going to happen to the small business sector, to professionals who might be using their corporation as a way of doing a pension. For me, though, I think some of the things that mitigate those concerns here is there's a threshold of $250,000 that you have to have more than $250,000 in a single year of capital gains before the higher rate is applied to your personal return. In addition to that, there's a higher lifetime capital gains exemption that's as part of the package. They'll help out some of those entrepreneurs. So there is some focus on trying to help out those folks who might be caught up in this change. But at the end of the day, if you have more than $250,000 of gains in a given year, you're likely doing pretty well.
You do have some ideas as to whether, as what we can do to boost productivity. Of course, it's a huge question. You do think that stimulating investment by Canadian companies is a good thing. I mean, they are apparently laggards when it comes to training and investment per employee.
Yeah, I'm certainly one who thinks that we ought to be growing the economy, that we should care about things like GDP per person. I'm certainly on line with that. And one of the ways to get there, one of the best ways to get there, is to make sure that our companies in Canada are investing a lot in the Canadian economy. Where I'm not so sure is that, using the tax system by moving things up and down on the personal income tax side is the best way to do it. Mm-hmm. So for me, you want to have the tax incentive closest to where the decision is, which in this case is tax incentives directly for investment, like the accelerated depreciation measures that are just now expiring. I think we ought to renew those. As other things, want to make sure that our population is growing and that we have great education, great training. We're doing the best of making use of the skills of the talent we have here. There's lots of things we can do. I'm just not convinced that moving the capital gains rate up or down is going to be like a top thing that we want to do in order to increase the growth rate of our economy.
Yeah, you wrote a rather sardonic, partly sardonic piece, op-ed for the Globe and Mail, and you said Waterloo, Ontario has been a great tech success, but it wasn't launched because of low capital gains tax rates. It was partly because regional business leaders worked with the university and the provincial and federal governments.
Yeah, I think that the University of Waterloo is a great example. Just think of the hundreds of thousands of jobs and the billions of dollars the Canadian economy has benefited from because some smart people back in the late 50s decided to start up the University of Waterloo. But that happened because you had the government working together with the private sector to build something great that really benefited Canadians. So we should think about those things. Taxes can matter, and they do matter, but we also want to think about the spending side of the government budget and ways that we can work together, private sector and public sector, to create those kinds of opportunities to grow our economy for the future, which is, of course, what underpins our prosperity. We want to pay attention to that. That's what, it's the economic growth that pays for our healthcare, our pensions, and all of those other things that we like to do in the public sector. Mm-hmm. In order to afford those, we need to have a growing economy.
What about, we have a small market, obviously, a geographically challenging market, so it can be hard, arguably, to attract foreign competitors in. But do we have cartels in this country, oligopolistic structures that hold us back, do you think?
Yeah, there's lots of things that are holding back corporate investment. Taxes may be one thing, but other things that we can think about is competition policy that, because we have in some industries fairly tightly regulated entry, we don't have that pressure of competition that will make firms invest in new ideas, new techniques, new people, and to really kind of add those competitive juices to our economy that can lead forward to the production of new ideas, new companies, and new startups that are really the dynamic of the economy we want to build. Beyond the investment side of the argument for, better competition policy, we also want to think about the benefits for consumers. If we have a lot of competition, that means prices for consumers can go down. And so I think there's a lot of benefits for thinking about kind of taking those shackles off the Canadian entrepreneurs by allowing them access to really competitive markets across our economy.